Hey everyone, in this video we'll break down one of the most effective smart money trading strategies, the order block. In this order block setup, we combine market structure with order blocks. This method allows you to spot clear and high-quality trade opportunities. If you're looking to understand advanced trading concepts, strategies, entry methods, and how to maintain discipline with your trading plan, be sure to hit the like button to show your support, and don't forget to subscribe if you're new. I'll see you after the intro and disclaimer. Before we dive into the trading plan, we first need to review a few key concepts about order blocks and market structure, as these will be applied later in the strategy. Let's start with the fundamentals. What exactly is an order block? Order blocks are essentially refined supply and demand zones. From basic price action, we understand that the market consistently moves in impulsive and corrective waves influenced by participant behavior. We define the origin of an impulsive move as a demand zone. This is because, within that area, traders previously initiated long positions with intent. If price returns to the demand zone, the probability of buyers stepping in again is higher. In simple terms, demand zones identify areas where we anticipate renewed buying pressure. Likewise, the beginning of a downward move is considered a supply zone where traders earlier entered short positions. When price revisits this zone, the likelihood of selling activity increases. In other words, supply zones point to areas where we expect sellers to re-engage in the market. Now, order blocks are a type of supply and demand zone, but they form when a significant number of buyers or sellers enter the market, creating a price imbalance. This imbalance between buying and selling pressure is visible through fair value gaps. Such gaps occur when price moves rapidly, leaving orders unfilled, and the market may later return to these areas to restore balance. We highlight the candle before the gap as our order block zone. Since we assume decisions were made during that candle, the expectation is that if price revisits this order block, it could react strongly as buyers or sellers step back in. So essentially, order blocks are supply and demand zones, but the distinction lies in focusing on regions where larger institutional orders are placed. Now, how do we identify the order blocks? We mark the entire candle before the fair value gap as the order block. The candle's color is irrelevant. For instance, in a bullish gap, it makes no difference if the candle is green, red, or even a doji with a weak body. All of these qualify as valid demand order blocks. Here's a crucial detail. Sometimes a wick captures liquidity before the imbalance begins. In that scenario, we also include the wick within the order block zone. This marks the true start of the imbalance, and our stop loss should always be positioned below this wick for safety. Order blocks can be either small or very large. When the zone is narrow, it's better to apply a wider stop loss beneath it, because even though order blocks represent strong supply and demand zones, price doesn't always reverse precisely from the box. It needs room to breathe. Conversely, when the order block is broad, you can place your entry closer to the middle of the zone for a more favorable price, or shift to lower time frames to search for confirmation and rejection signals. So, what makes an order block high quality and worth trading? The critical factor is its alignment with market structure conditions. In an uptrend, price develops higher highs and higher lows. Each time price breaks structure to the upside, it indicates continuation of the trend. The bullish order blocks formed along the path have a stronger probability of rejecting price upward if it retraces to them. This uptrend remains valid until the market breaks below a protected low. That event is called a change of character, and it suggests a possible reversal. It signals that sellers have taken control and pushed price downward. The bearish order block responsible for this shift becomes a prime shorting opportunity. From there, if the trend begins forming lower lows and lower highs, the bearish order blocks created along the way also serve as solid trading setups. The concept of market structure extends further than this, but this gives a simple outline of how order blocks form and how to apply them. Now that we've explained order blocks and market structure, it's time to discuss the trading strategy. This method uses 2 time frames and is simplified into 5 clear steps. Analyze the market structure on the higher time frame to determine direction. Mark the order blocks. Wait for a pullback, then look for a change of character confirmation on the lower time frame. Finally, enter at the lower time frame order blocks. As mentioned earlier, this setup requires two time frames. The higher time frame, which is our main chart for day trading analysis, and the lower time frame, which we use for confirmation, entry, and trade management. The exact time frames you choose don't matter, but the entry time frame should always be at least 2 times lower than the higher time frame. For example, this combination of time frames is commonly used. Another key point is that this strategy can be applied to any asset. It doesn't matter if you're trading Forex, crypto, or stocks, since price action principles remain valid across all markets. However, always backtest thoroughly before risking real capital to evaluate how the strategy performs. Now, let's return to analyzing market structure. The first step is identifying the market direction. Trading with the prevailing trend generally provides a higher probability of success. To determine direction, we look for breaks of structure, changes of character, and reversal patterns on the chart. If the market direction is not clearly visible on a time frame, it's better to skip that pair. Trading when the direction is uncertain increases risk, so it's safer to focus on pairs with a clear trend for better decision-making and risk management. Next, we locate fair value gaps and mark the order blocks, which serve as our primary trading zones. At this point, we could simply set a sell limit at the order block and place our stop loss above it. However, for a more conservative approach, we zoom into lower time frames once price reaches this area to observe its reaction and confirm the trade. We want to see a rejection from the order block to ensure it is respected. Even though this forms a high-quality trading setup, price does not always reverse precisely from the box, and the market can sometimes ignore the order block. The following step is to wait for a pullback into the order block zone. Then zoom into a lower time frame. Remember, avoid entering the market before price reaches the order block zone, as the market often traps premature buyers. In the final step of this trading plan, we look for confirmation and execute the trade on the lower time frame. After price enters our trading zone, we need confirmation that the short-term uptrend is finished and price is ready to decline. To confirm this reversal, we look for a change of character, which occurs when price breaks below a swing low. This verifies that the short-term uptrend is complete and price may continue moving lower, aligning with the bearish higher time frame trend. Once the reversal is confirmed, we wait for bearish order blocks to form and then place the trade. This is why the method is called order block within order block. The lower time frame order block does not always need to be fully inside the higher time frame order block zone. After spotting the lower time frame order block, we set a sell limit at the beginning of the zone and position our stop above it. For the first target, we shift the trade to break even by closing half the position once price reaches a 1 to 2 risk to reward target. The next target is the first major zone ahead of price on the higher time frame. Here's a quick recap for the bullish scenario. The same rules apply, only in reverse. We wait for price to reach the higher time frame order block. Then we look for a change of character on the lower time frame, which occurs when price breaks above a swing high. This confirms that the short-term downtrend has ended and buyers are taking control. Once confirmed, we search for bullish order blocks on the lower time frame and place a buy limit at the beginning of the zone, with the stop loss below it. Targets are managed in the same way as in the bearish setup. Now, before moving on to real chart examples, let's go over some common scenarios and how to manage them. Scenario 1. A very small order block on the lower time frame. In this case, use a slightly wider stop loss zone to protect the trade from normal market fluctuations. A stop that is too tight can be triggered too easily. Scenario 2. A very large order block on the lower time frame. If we place our stop loss below the entire zone, it may become too wide and reduce the risk to reward ratio. Instead, we can either select a smaller zone just below the order block as our stop, or place the entry closer to the midpoint of the zone. Both methods help improve risk to reward. Scenario 3. Multiple order block formations. We can trade all the order blocks as long as they offer a reasonable risk to reward ratio. But always remember to trade with reduced risk. Never risk more than 2% of your account on a single trade, and avoid having more than 3 trades open at once. The objective is not to win every trade. Losses and missed opportunities are a normal part of trading. Our focus should always remain on finishing the day with an overall positive result. Now, let's move on to some real chart examples to see exactly how this trading plan works in practice. Here we have the euro-dollar on the 1-hour chart. Recent price action shows the market was in a long-term downtrend until it shifted direction by breaking above this protected low. This change of character signals that demand is now in control and suggests a possible reversal with the beginning of a new uptrend. Since the higher time frame direction is bullish, we are only interested in buy setups. Next, we identify the fair value gaps and order blocks. In this example, we can spot two fair value gaps. We mark the candles that created these gaps as our order block zones. These zones become our key trading areas. If price retraces into these zones, we then zoom into the lower time frames to look for confirmation signals and take the trade. So let's see what happens. Price has tapped into the first order block. So we switch to the 5-minute chart to search for an entry. On the 5-minute chart, we look for reversal signs to confirm that the order block is being respected before opening a long position. For confirmation, we need to see a change of character, which occurs when price breaks above the swing highs that triggered the breakout. Let's move price forward. Here, we see that price broke below the order block without showing a clear change of character. Although there was a minor reaction at this zone, we did not get the confirmation we needed. Therefore, no trade was taken. Now, let's return to the 1-hour chart. On this chart, we still have another unmitigated order block zone below. If price drops into this zone, we will once again zoom into the lower time frame to search for an entry signal. Let's see how price develops next. Price has now tapped into this order block, so we switch to the 5-minute chart once more. On the 5-minute chart, the market has already shown a change of character, which is the reversal confirmation we were waiting for. This indicates the short-term downtrend is finished, and we can now look for long trades with confidence. The next step is to wait for price to create order blocks and then take long entries. Here, the market forms an order block. So, we enter a long position. As price continues upward, another order block forms without cancelling the first trade. We open a second long position at this new order block. This method is important because a pullback to the first order block is not always guaranteed. Sometimes, price only reacts to the second order block before continuing higher. In the worst case scenario, price could drop and hit both stop losses, which is why we always trade with reduced risk. Let's see what happens. Price takes out the stop loss of the second trade, but activates the first one. Then, another order block forms. Again, without closing the first trade, we place a long entry at this new order block. We continue repeating this process until the market reaches our target, which in this case is the previous high on the higher time frame. This strategy has proven to be profitable, but it must be backtested before applying real capital. The reality of trading is that even with a solid plan, you will still encounter losing trades. That does not mean your analysis was incorrect. The key is to write down your rules, follow them consistently, and stick to your risk management plan. If you do this, you'll be fine in the long run. So, that's it for this video. Thanks for watching. I hope you found this valuable. If you did, be sure to hit the like button to show your support. And if you're new to the channel, don't forget to subscribe. See you in the next episode.